Hello, Dawn Santoriello, founder and CEO of DS Financial Strategies here, and welcome to the Quarter Two Client Newsletter. When winning doesn't mean you always come in first. Nothing puts a chill on the mood of investors like the specter of inflation. Not only does it dampen demand for goods and services for consumers because they're reining in their spending, but it also tends to create a less favorable business environment as the Federal Reserve aims for higher interest rates, raising the cost of corporate debt. So it's not surprising that in early April, higher than anticipated inflation numbers sent stocks falling. However, as revised and more accurate numbers came in, the Fed signaled their intent to cut rates later in the year. This, along with better than expected first quarter earnings, caused the market to regain lost ground. And the second quarter ended with a gain of 3.48%. This brought the increase for the previous 12 months to a healthy 23.78%. Again, the biggest growth came from a narrow group of growth stocks. Also, the yield curve remained inverted, seen by some as a sign that a recession could be on the way in the future. And popular alternative investment Bitcoin, which had a record-breaking first quarter, settled back to its February level. With this kind of mixed data, you could plausibly argue for the wide range of near-term market behavior. It's no wonder that strategists have been giving guarded opinions saying things like, yes, these gains are good, but the stocks could tumble at any time. It's the kind of statement you see in the financial media anytime the market does better than expected. And once again, the market rewarded those who shrugged off the short-term losses as they stayed in a position to benefit from unexpected gains. However, good feelings can be just as deceiving as bad feelings. Long-term investors know that just as take their temporary paper losses in stride, they should also be stoic about their short-term gains. It feels too good to open your quarterly statement and see that your portfolio has made significant gains. But pleasant emotions are not the ultimate goal when investing for retirement and can in fact hamper clear thinking about your financial strategy. For example, it's easy to think that a broadly diverse portfolio has decent gains for the quarter. Wouldn't it make sense to double down on some of those high-performing tech stocks and see even better returns? Decade after decade of research has shown that for the individual investor saving for retirement, pursuing short-term gains is far more risky than long-term discipline. Let me repeat that again. Pursuing short-term gains is far more risky than long-term discipline. In just a few weeks, you'll have a chance to watch the Olympic decathlon, one of the most anticipated displays of athleticism in track and field. To win this grueling contest of 10 events in 2 days, and maybe to get the picture on your Wheaties box as the world's greatest athlete, the contestants, they need to take a counterintuitive approach to winning. They need to plan on losing most of their events. When the U.S. decathlete Ashton Eaton won the gold at the London Olympics, he finished first in only 3 of the 10 events. Even though he set an Olympic record in the first race, the 100-meter dash, he didn't grab a flag and take a victory lap. He had to get ready for his next event. At the end of the second day, when he lined up for the final race, which was the 1,500 meters, just under a mile, the goal was purposely not to win. The decathlon is scored by points. To tally the highest total, Eaton needed to only finish in the middle of the pack. And so his strategy for winning the overall gold included letting at least 10 other runners finish ahead of him. Why? Well, Eaton was built like a sprinter, and an attempt to take the first middle distance race could have ended up him running out of gas halfway through the race, nullifying everything he'd accomplished over the past 2 days. He stuck to his strategy, letting multiple runners pass him, and he traded a loss in the 1,500 meters for the decathlon gold. In the same way that the long-term investor with a broadly diversified portfolio should expect his or her quarterly performance to come below that of the season's highlighters, like Eaton's strategy, it's by design. Berkshire Hathaway CEO Warren Buffett has stated that investors who get caught up in the short-term thinking actually benefit those with the long-term view. Many investors, Buffett said, some of them are big, constantly trying to outsmart each other. He adds that this game is focused entirely on short-term profit. This leaves much more opportunity for those who are in it for the long term, such as you saving for your retirement. In addition to maintaining a long-term view, the prudent investor will also acknowledge their own shortcomings when it comes to gauging things such as future performance of the economy. We saw how some of April's early decline could be attributed to investors responding to economic data, which later turned out to be inaccurate. We as individuals tend to have a limited data set, what we heard from our friends or our family, maybe we learned on the financial media, and take that as an accurate picture of the economy as a whole. If we can't find a job, unemployment is the problem. If a landlord raised our rent, then housing costs are an issue. A University of Michigan study found, unsurprisingly, that people's political affiliation is a significant effect on their economic expectations of the near future. If you support the party in power, you think things will be getting better. If you like the opposition, you're much more pessimistic about what's around the corner. It's good to remember that the economic data is a generalization describing what happened for hundreds of millions of people. Your experience most likely has been and will be very different. As a prudent investor, you don't need to worry about what experts say is going to happen, especially in the near future. Working in partnership with a trusted advisor such as myself, you are free to continue along with your financial plan created specifically for you and your unique needs and based on real numbers. Rather than fear in the future, you can take a diversified, long-term approach that expects ups and downs and so looks to maintain flexibility while building resilience. Acting on things you have control over is much more productive than worrying about things on macro level trends. Thank you and have a great day. Oh, if you need to reach out to me, sorry, I forgot to add that. You could go to dsfinancialstrategies.com and click book appointment, or you could call me at 215-660-0288.